Hi everyone, my name is Devan McLaren, and today we're going to be running through the Pro Forma Model tutorial. This is a tutorial on how to use the Microbusiness Pro Forma Model, which is an Excel file that will help you prepare forecasts for your microbusiness license, and will help you show prospective investors or lenders or business partners how you expect the business to perform over time and what components of this license you're intending to activate and when. And this model will be able to provide a lot of detail. It should be helpful for you to understand your business and plan effectively. And we hope it's a really useful tool for you. I helped prepare this tool. I built it. My name is Devan McLaren, as I mentioned. I am the founder of Triple Beam Advisors, a consulting practice that I started in 2017 to support, among other things, cannabis businesses. I've supported cannabis businesses across the supply chain through this business. I have worked with countless licensees across all different states, and I'm really excited to be working with you guys and helping support your microbusiness licenses in New York. I also am the vice president of our academy, 501c3 nonprofit that has spent the last 2 years supporting the New York market on the retail side with pro formas, expert courses, and office hours. And we did that in a government contract with the Office of Cannabis Management. So lots of experience in New York, lots of experience working with all types of licenses. And so that is why I'm here today to help explain how to use this tool. And I hope it's going to be very beneficial for you when you're running your business. Just a quick disclosure. Anything that you put into this model after we provide it to you is an assumption that you're adding to it. We don't guarantee that the assumptions that you're going to put into it are going to be completely accurate with what's in the market. We're not co-signing the assumptions you use. We're just providing this tool so that you have an ability to prepare a pro forma like this without having to spend thousands and thousands of dollars to have one built. Very time consuming to put this together, which is why we want to provide this benefit to the microbusiness licensees. These are complicated license types with lots of moving parts, which is why a tool like this is necessary. But again, just read over this disclosure. There's going to be another quick one in the model itself, and you just want to approach with caution. Know that you're preparing estimates, and there's no guarantees that these estimates will come to life. Before you begin, we're just going to run through a couple housekeeping items. This model is an Excel file. You will need to have Microsoft Excel for it to work. I would recommend that you use the desktop version of Excel, and I would recommend that you use one that's a newer version, probably 2009 or 2013 or sooner. The file is pretty hefty, but it should be very user-friendly with the accompaniment of this video walking you through it. I will walk you through and put up my screen in a moment here how to set up the Excel settings so that this model can work properly. And that is a really crucial step, not to be skipped. So let's jump into that, and I'll show you exactly how to set up your Excel application so that the model can run as smoothly as possible. Hi, everybody. Before we begin, we're going to run through some Excel settings that you're going to have to make sure are set before you get started, just to make sure this model is working properly. So what you're going to do first is you're going to go up to the top left. You're going to click on File, and then near the bottom there should be something called Options, which you're going to click on, and then you're going to go to Formulas. And once you're in here under Formulas, there's these calculation options here. First, you're going to want to make sure that your workbook calculation is automatic. If you do find that the calculations are taking a really long time, if you have a slower or older computer, then you can switch this to manual, make all the changes to the assumptions you want, and then just hit save, and then that will run the calculation. I do prefer to have it in automatic if your computer can support it, just because then you know that at all times you're looking at the most recently updated version. You'll update one assumption, and then a lot of different cells will change once that calculation happens. So you don't want to have a case where you update a number and then you look at a table thinking that that's the updated, but it hasn't actually calculated yet, which is what can happen with the manual one sometimes. So try to go for automatic. The next one is very important. You have to make sure that this cell is checked, this enable iterative calculation. And what this is going to do is just allow Excel to run multiple calculations over and over. It'll make it quicker. It'll make sure that the calculations are more accurate. So it's very important that you do this, especially with a model of this size and caliber. And then you're just going to want to set this maximum iterations to 250. That means it'll run calculations 250 times to get to the best possible answer. You could go higher on this if you really wanted, but it's not really necessary. You do want to have 250 though, just to be safe. Once you have those updated, that's all you need to do. Super quick. It should remember it once you save the file. It'll remember these settings within that file. So you should have no problems. If you do go in and open up this file and you get a notification window that says that there are circular references, then that means that this box most likely is not checked. You check this box, it should resolve everything. You'll hit OK, and then you're ready to use the file. So if there's an option up here that says enable editing or enable content, you can say yes and OK to those just to clear them up. And then you're ready to use it. So without further ado, I'm going to pause there, and then we will jump into the model walkthrough. First things first, we will be running through now the executive summary tab, which is basically just a summary of all the inputs that we put into this model. So you're going to see the model here now on the screen. This executive summary tab here is going to include a bunch of information. We'll walk through each of these kind of one by one. Zoomed out for now, just so you can see all the different tables that are included here. And I'll zoom in and we'll start to address this one by one. All right, so first up first, at the top here, we have some just general information. Within this model, almost everything that you're going to actually edit as an input is going to happen on this assumption tab, with the exception of these three cells here: address, name, and license number. So you can just put in your identifying information so that if you do send this to somebody else, they know what company it's for. Just a helpful thing to include there. We have some really high level information about the business here. It's just basically your canopy. So you can see this is built for currently an indoor cultivation, which caps out at 3,500 square feet of canopy. And then we have our non-canopy square footage there. We include things like capital raise assumptions. We do talk about what some of these terms mean in some of the courses that were provided to you. So hopefully you're familiar with these by now. If not, you can go back and watch those courses that were provided in conjunction with this model, and they'll help explain what some of these things mean. You have your pre-money valuation. That's the valuation that you're raising your equity at. Your post-money, which is the pre-money plus however much money you're raising in equity. How much is the investor owning? How much does the founder own? What's your distribution start date, payout ratio? We'll get to those in a bit when we walk through the assumption tab. We have a sources and uses summary here, super high level. We don't need to go into too much detail on this summary tab. You may have to prepare something similar to this. It's a little bit more detailed for an investor. This should cover it for most people. So you have your construction budget, equipment, machinery, and then a working capital line item as well. You can see on the left side here your capital sources, so equity and debt. We have the ability in this model to run any combination of both of those. This bottom section here talks about some of the main KPIs and indicators for each of the four segments that can exist in this model and for this license type. So if we were to go all the way over to the right here, we have summaries for each of those four different segments. And we'll see on the assumption page that we have that as well across the side here. So these are just going to be some general call outs to give the potential investor or business partner an idea of what this business is going to look like and which of these segments are actually going to be used, because the microbusiness license does have a lot of different combinations that you can run with, which is part of the reason why we need a big complicated model like this. This bottom section here is going to talk about terminal value calculation. So the reason that we calculate this is not necessarily telling you have to sell this. A lot of people hold this for a very long time, but it does establish an end value for what the business could be worth. And the reason we've established that end value is just so that we can get some kind of reliable investor return in here, which will just help us understand whether it's a good investment for them or not. So this section here, we do calculate this based on a revenue multiple and EBITDA multiple for the trailing 12-month period. That's the last 12 months of the forecast. So this forecast right now is 5 years. You go from 2025 to 2029. You can update those dates, but it will be 5 years no matter what. This is basically saying, based on the EBITDA and the revenue in the last year of operations, the last full year, we're going to take an average of those two multiples there, which you can edit on the assumption tab. And they'll give you an exit valuation. You're going to add your cash into that, and then you will see how it gets split out between founders and investors on the right. Down below, we can see the cash flows. So cash flows for investors annually. You can see in this case, the investors are coming in with almost $3.7 million in the first year. And then by 2027, which is the date that our distributions start up here, by 2027, they start taking some distributions out of the company, and you can see how much they're taking out, about $2 million a year there. And then we have their portion of that terminal value that's been calculated here. On the flip side, we have our founder cash flow below, which is basically just the rest. So in this case, the investor has 49% and the founder has 51%. So you can see they're pretty close. Founder's getting a little bit more each year on those distributions, a little bit more on the terminal value. And you can just see that net cash flow here. So anybody would be happy with this business. It's running pretty well, very good returns for the investors, decent returns for the investors, and very good returns for the founders. The next section here on the left, you'll see this annual financial forecast. So we go over the 5-year period of our forecast model, and this is just a summarized income statement, balance sheet, and cash flow statement down below here. These are what would be called your 3-sheet financials. So these are all the financial statements that an accountant would prepare for you on an annual or semi-annual basis. And this is just going to really help give you an understanding and a snapshot of the company and what the business is doing, how it's performing. You'll look at things like revenue growth over time. You'll look at things like what's your gross profit, your gross profit margin, quite healthy here. See how your expenses are broken down by different items. You'll see your EBITDA and EBITDA margin here, which is currently very strong. And then you'll also see at the bottom just your net income, your taxes, your interest expense, etc. Balance sheet will show you things like your debt, long-term liabilities, if there's a line of credit that you're drawing down, what the total balance is on that line of credit, any capital is paid in, dividends paid out, etc. Cash flow will show you basically investments that you're making, capital investments. It will show you how much you're drawing down or paying off on loans, capital raises, dividends again, and cash at the end of each period. You'll see at the very top right corner here some error checks. You're going to want to make sure that all of these say okay. We're going to do a little bit more of a deep dive on this in a later section of the video, but double check this before you really trust any of these numbers. You want to just make sure that these are all zeroed out and these all say okay. Let's just make sure that the model's working properly. All right, so that's the executive summary. You're going to use this to provide a little snapshot of your business to, for example, an investor or a prospective business partner, or you just are going to look at this to see what the impact is of all the assumptions that you populated into the model to reflect your business. Awesome. I will jump into the assumptions next. It's a long section, but we're going to break it up into a few different parts. Next up, we're going to be looking at financing and capital expenditure assumptions, which is the top section of this assumption tab. So we look at it here, we jump into this assumption tab. It's a very long tab. There's a lot going on. I'm going to zoom out just so you can see a lot of information on this tab. We're going to break it into little sections so it's a little more digestible. This is the only tab, really, with the exception of a few inputs here just about your company. This is the only tab that's actually going to be requiring you to input and change any cells. Everything else in this model will run automatically. You'll notice that if you were to go into the income statement, for example, and try to delete this cell, you're going to get an error message. The reason that we have all of these other tabs protected is to protect the integrity of the model so that you can't accidentally delete something that's then going to ruin the integrity of what these outputs are saying. So The only things you need to change, it's nice and tidy for you. You only really need to worry about this assumption tab. And we'll walk you through each of these different sections. So the first section here is your financing and capital expenditures. So basically what we have, the way this whole assumption tab is organized, is we've got cultivation, manufacturing, retail, and delivery. You may have all of these, you may only have some of them, but we provided the ability to break it out, all the different cost inputs, etc., by each segment, just to help visualize it and see what's the total investment that we're going to have on each of these different business segments. If you didn't want to use this, if you wanted just to input everything in one and zero out all the rest of these, you can totally do that. The only place that you're going to see these come in is on these finance tabs. That's the financial statement tabs. You'll see it in the cash flow here, for example, improvements, equipment, machinery, and vehicles. You'll notice that these here and the capital raise as well, they're not broken out in these financial statement tabs here, these 3-sheet financial statements by segment. They're just totaled. So this summary here, it doesn't really matter if you put it all in one column or you put it spread it out across different columns. It's really just to have this summary if you wanted to do that. So the way this works is that we have timing on the left for each section, and then we have the amount on the right. You'll notice these are all drop-down menus, so you can't mess it up too bad by, if you're rounding off and missed a couple decimal points. It should be relatively straightforward and easy to use. We've got it set up this way so that you can basically determine, in this case, we have a cultivation that's starting build out in March. Manufacturing, we're going to start that in June. Retail in September and delivery in October. So we're kind of spreading out these capital expenditures. If you looked at the cash flow here and you look on the monthly, you're going to see the timing of these kind of spread out over time. This is probably the way you'll do it, but maybe you'll do everything at once, and that's okay too. We've got our CapEx down below here. These can be really, you could have some equipment that you buy early and some that you buy a little later on. Maybe you're going to upgrade your equipment after a year. And this just allows you 2 different rows to spread out those expenses if you like, or put them all in one. Above here, things like your tenant improvements and other startup costs, these are all going to be things that you should have a good handle on at some point. You're going to probably put rough estimates in there at the beginning and just update it as you go and get better information from people like your GC, etc. This working capital line is pretty important. We'll talk about this a little bit. Basically, this is everything else. So in your business, when you're raising money and you're thinking, how much money do I need to raise? Things like your build out cost and, things like we need to buy uniforms and mats and we need to buy display cases and all these different things. Those are going to be pretty easy to determine in your budget. The thing that's going to be a little trickier is the working capital. So this includes things like for the period of time that you are running your business and paying staff before you have revenue. This covers stuff like that. It covers time after you're receiving revenue, but you're still not profitable yet. It covers all those different working capital expenses. And so this is kind of a catch-all. So it will cover any shortfall that we have, we're going to cover with this line item. When I talk about a shortfall, you're going to want to look at this little area here. If it says fully funded, that's good. That means that you are funding all of the expenses that you put into the model with the capital that you're talking about raising. If you were, for example, to zero that out, now you'll see these red ones come up. That's your cash flow shortfall. And you'll see down here, boom, we have an error message, cash flow shortfall. If we went on to the executive summary and we went back to this, remember this tab here? That is an error saying that we are about $1.8 million short in terms of funding our business plan. So what are we going to do? We're going to go back and we're going to look at one of 2 things, either debt financing. We could go and raise a whole bunch more debt and try to cover that, but debt comes with interest. And so if we wanted to cover 1.7, we'd probably have to go and raise quite a bit more than that because of interest costs. So maybe if we have 2 million, maybe that'll work too. Nope, that's not going to let me update that. We'll come back to that. Or we can put in $1.6 million here, which is what we had before. And then we'll see that error go away, and we'll see we actually have an extra $10,419. So we are fully funded at that point. So two different ways. You can either change those debt options here and increase the amount of those loans, or you can go in here and change this working capital. One of those two will work, and it will cause you to be fully funded. This section below here, source of funds, I would probably do this last after all those other assumptions below. The reason being, once we put in all these other assumptions down below about costs and revenues, etc., are we actually going to know how much money we need, and how much we need to raise from investors, and how much debt we need to raise, and all of these good things. So again, you have the ability to set the timing of when this capital comes in. You have the ability to show how much of the capital is going to be raised by the investors versus how much the founders are going to put in. And then you have the ability to set different terms, so interest rate, number of months, if there's a balloon payment for these loans. Now, one quick caveat, there's a lot of different ways to structure loans. We could not cover all of them in this template model. The intention of this model is to be something that's quick and easy that everybody can benefit from. So if you do need something that's more complex, you need to build in some other loan terms and you want to get very specific, you can definitely go and reach out to us on this contact page here under this link, and we can try and help you out with that. We would charge that hourly, and that's an extra service, but because the model is already built, it's relatively easy for us to update this. It wouldn't take too much time. So that's a quick caveat on that. The bottom one here is line of credit interest. This is just an interest rate that we're applying to a line of credit in the model, which is basically just a function the model has. It doesn't, you may not go out and get a line of credit, but the way this model works is if there is a shortfall, when we go back here and we zero that back out, and you've got that $1.77 million shortfall, and we look at our cash flow statement here, we're going to see that this line of credit is getting drawn. And if we look again at the balance sheet, and we look at this monthly, we're good for the first 6 months. And then we have to start drawing, and our balance on this line of credit is growing and growing and growing. And if we watch where it peaks out, it's going to peak right at that 1.77, and then we're going to start paying it off because we're starting to make some good money. But that total peak of 1.77 million there is the amount of the shortfall that's calculated by the model. So what this model will do is it'll say, okay, well, there's not enough money, so we better draw from this imaginary line of credit. And by the way, money's not free, so we're going to put a 15% interest rate on top of that. If you have an actual line of credit, you can change this interest rate to match that. But for now, what you're going to want to do is try to get this number as small as possible, if not down all the way to zero. So that this line of credit is then not being used. So if we put this back up to 1.6 million, for example, and then we enter into this cash flow, we'll now see this line of credit doesn't draw down at all. If we go to the balance sheet again, we look at this line of credit, there's nothing. And that's because we're fully funding it with our equity and our debt that we're inputting on this assumption tab, which is good. The next section here is the valuation section. You can input a different valuation here, which is going to be your pre-money valuation for the license. And then you're going to adjust how much ownership that equity investor is going to get. And it'll use this amount here, this total investment up here, to basically calculate out what that post-money is going to look like. It's pretty high level. Again, there's a lot of ways you can structure equity investments. You can have preferred dividends. You can have all kinds of crazy stuff. And again, if you need help with that, feel free to reach out. We can help quote that out for you. Down below here, we have things like a distribution start date. The reason I would typically encourage you just to push this out to year 2 or year 3 so the business has time to stabilize. If you were to update this, for example, to 2025, while the business is still growing, then you're going to have an issue, because what's going to happen, if we look at our cash flow statement, you're going to start issuing dividends because there's going to be some cash in the model. But then when we need to cover cash shortfalls, you're going to start digging into a line of credit. So you'll have this cycle where you're taking money out for dividends and you're funding it with your line of credit, and then and you don't want to have that. You want to avoid that. So the way that we do that is we push out our dividend start date just a couple of years. Once the business is stabilized, once we can see that we're generating significant cash from operations, then you can turn those dividends on and you won't have any weird line of credit issues. The payout ratio is going to be the amount of money at the end of each period that you're going to, so if you have $100,000 at the end of the period, 80% of that's going to get paid to dividends, and the rest will just stay in the company and be reinvested. You can adjust this however you like. The terminal value date is going to be set. That's just the last month of the 5-year forecast period. And then the revenue multiple and the EBITDA multiple here are going to be how we're reaching that terminal value calculation again on the front tab here. That's going to feed these two numbers. These numbers change a lot with the market. There's no telling what these will be at the end of 5 years. They could go up, they could go down. It's very hard to predict, but this is pretty close, I'd say, for now. Maybe we could get a little bit more out of that revenue multiple, but pretty close for now to market. It is hard to predict with the microbusiness license because there's not a lot of them operational. There's certainly none of them have sold yet because it's only the time of this filming in September of 2025. But once you start to get some comps, you can update these numbers and get a little bit more dialed in. The balance sheet assumptions, I would recommend that you just leave these and not play with them unless you are an accountant or finance person that understands what these mean, and you can go in and make these adjustments. But the model will work perfectly fine with the numbers that you've got in here. It's not going to make a huge difference for you. So recommend just keep it as is. All right, the next section will be costs, and we're going to jump into that on the next video. All right, our next section is going to be going through the cost assumptions in the assumption tab. So what we're going to be going through here, we're going to be looking just at all of the different factors that are going to impact your business on the cost side of things. So operating expenses, selling, general, and administrative expenses, and taxes, just as an example. You'll see again, familiar, 4 different segments. You can break this all up. These will be important on how you split these if you do want to have accurate segment level P&Ls. So if we look at our manufacturing tab, for example, what you'll see here is you'll see some costs and revenues that are broken out specifically for that white label segment. You'll see that we have a revenue all the way down to operating profit for that segment with operating margins and different KPIs on what those margins are. If you don't put in the relative share of the costs into this business segment on the assumption tab, so if you're not entering them into this manufacturing line item here, you're going to miss, those margins are not going to be very accurate. So if you want to have the benefit of being able to see these individually, then you can put them in different ones. If not, you can zero these all out if you're just going to put it all into one and you're like, I don't want to figure out what the relative share is of G&A expenses across each of these different functions, then that's okay too. Each of these is going to have a start date. You're going to want to make sure that the start dates for these business segments are going to begin in and around when you're building out each of these segments. So for example, if we look at the cultivation, we're going to have tenant improvements hitting in March of 2025 in this example. So the business segment starting in January 25, that is close, that's okay. The cultivation has to be a function of this license type, so it has to be there. The manufacturing, retail, and delivery could happen or don't necessarily need to happen. So there is an error check here. If you were to try and start the manufacturing business before the cultivation, so if we were to change this cultivation to February and change the manufacturing to January, it will show you an error message there because you don't have any product to manufacture yet because your cultivation has not actually produced anything yet. So that's one little error message to flag. If we just go back on that and there we go. There's lots of tags throughout here that are going to explain what to input on each cell. So I won't go through in excruciating detail. You can always just hover over and they'll tell you what to put in there. You're going to want to break those out by segment as we discussed. This top section is pretty high level: marketing, advertising, professional fees. If you have a management fee that's a percentage of revenue, you can input that here as well. We have our property expenses. So the way this works is we do assume that there's one building. So you enter your total square footage here. If you have two different buildings, which is possible for this license type, add them together and put them into this number here. And same for the lease rate and the additional rent. And then what you can do is you can split these by percentage. So if you have, for example, 60% of the square footage is going to be used by the cultivation, then it will populate that and it'll take its relative share of the lease rate. And that's what's going to populate each of those segment tab P&Ls. If you were to do bad math and not have it sum up to 100 across here, you will get that error message. That is going to trigger an error message here as well. So if you see this, it will tell you, go to the assumption tab, find the flag. So you're going to be looking for that error message just to go in. If it's one that has percentages like this, it just means you're probably not adding to 100. So once you get that right, this all sums up to 100, that'll go away. We have some rent increases, other expenses like maintenance and property type expenses are in here. We do have a 280E federal income tax put in here, which is a percentage of gross margin. If in the future you're using this model and 280E does not exist anymore and it's just a regular tax rate, you're going to want to go in and change this. It is wired to be a percentage of gross margin because of the way that 280E is calculated. Which is on, you can't deduct other business expenses. So you're going to want to just reduce this down to, whatever the percentage of gross margin would be on that tax rate. So you're going to have to do a little bit of math to figure that out if 280E goes away. And maybe we'll be able to put out an updated version if that happens for everybody. Okay, we have a state cannabis tax in here. That's for New York. That's a percentage of revenue. We've got that getting paid in each of the respective months for each quarter. Licensing fee, and then we have a social equity discount on that, which brings that fee down in half, I believe. All right, next section here is your salaried personnel. So you'll see there's different sections: senior management, sales, marketing, other, and then we also have payroll taxes below. So you can put in whatever names for whatever roles you want here. Anybody that you're going to hire that's a salaried worker. My recommendation would be keep this to salaried workers. Don't put hourly people in here because they're going to be covered by the sections below in the assumption tab. This is really just anyone that has an actual salary. You can also put in here if they have an extra benefit on top. So we have Social Security, Medicare, and insurance, employment insurance down below here. But if they have benefits that you were given, then you can put in a percentage here to bump that up. And then what we also have along the top, it's worth mentioning, is we have an allocation. So you can say, for example, well, I want, the grow master is going to be allocated, or that goes by each segment. So senior management spends 50% of their time on cultivation, 25% on manufacturing, retail, etc. That just helps break these up, and then that'll allocate those into each of those P&L tabs accordingly. If you wanted to see, you can adjust the dates of when these folks are going to be hired, and then you can go into this payroll schedule to see how that looks on a monthly basis over time. That's an option as well. Again, we do have these allocation percentages here. These error checks are just going to make sure these add up to 100 at all times. All right, the next segment here is going to be the cultivation assumptions. I'm going to pause the video and we'll restart in the next segment. All right, the cultivation segment. This is going to be the most important segment of your microbusiness license. This is where you're getting all your product from. This is how you're generating all the biomass for the other segments to benefit. And so this is an important one. So we're going to run through first the assumption tab, and then we're going to do a quick look at that P&L tab for the cultivation segment after. So without further ado, let's jump into that. All right. You'll see there is a switch at the top here. You do have to have cultivation as one of the functions for your microbusiness license. So this one should always be on. You're going to see this area allocation, which was set up above based on the numbers we put in for the property. But here is where you're going to put in your licensed square feet of canopy. You're going to want to, as this note mentions, you want to double check the regulations and make sure that whatever type of growing you're doing, whether that's outdoor, indoor, or mixed light, you're going to basically just turn on the one that you're going to be using. It's going to typically just going to be one of these three. If you're doing a microbusiness license, it's most likely you're going to do indoor, but I'm sure there will be a few people running the outdoor or the mixed light. So if you turn these off, then it'll zero everything out. It won't populate anything in the model. This one's on for now. And that allocation of land, if you do end up changing this, so if you were to say, I'm going to turn off indoor and then I want to turn on mixed light, you do want to make sure that you zero this out and make this 100%. So that's just one quick flag there. You're going to see this allocation, say okay. And what that'll do is it'll just make sure that all these calculations are actually populated properly. And if we were to go look at this cultivation tab here, you would have your mixed light section here, which is now populating all of these costs and revenues and everything under the mixed light section. And you'll see that the outdoor and the indoor are empty. If we go back to that assumption tab and just switch it back to indoor, so we're going to say indoor is on. We're going to say that's 0. We're going to say that's 100. And we're just going to say mixed lights off. Then we go back into our cultivation. Now we're going to see that's all running on indoor. And these assumptions are going to be all different for indoor, mixed light, or outdoor, because these are really different types of growing, different yields and different, very, very different types of yield calculations that are all down below here. So when you go through here, the way that these work, I'll just focus on the indoor for now. You can say how much table square footage you have per room. So that'll be basically calculating the total amount of table space. So it's similar to canopy, a little less than canopy square footage. You're going to have the number of plants per square feet in that room. So if you have an 1,150 square foot room and you have 0.4 plants per square foot, then you've got 460 plants per room. You can enter the number of plants per light. This is going to change depending on the grower. And that'll calculate how many rooms, or how many lights you have per room. You can enter then your yield per light, which is going to be our primary yield assumption that we're going to enter. So that's going to say that you're going to get an average of 2.5 pounds per light on each harvest. And the rest of these will populate from there. Grams per table square foot is a good metric. I should say grams. This one is going to be, anywhere from 50 to 80 is like a really, really good grower. You might fall a little below that, which is okay as well. Okay, the next section here will be the cultivation start date. The date will be entered in a drop-down menu here. Make sure that when you're doing it, you look for the right year. Just make sure that that's correct. The average grow cycle here is the number of weeks that it's going to take to grow from planting to harvest. And that's going to calculate the number of grow cycles per year. In this case, it's 5.8. So this will change depending on the number of rooms you have, your preferences on how long you want to grow those plants and when you want to make those harvests. The one down here, the months to achieve first harvest from the cultivation start date, is going to take a start of this date here, this entered date of, in this case, February. It's going to apply a number of weeks. This is different from this one only because it's the first planting. And the first planting may come from seed or it may be going from cuttings. So that will depend, the duration of that first planting will depend on how your selected grow method is going to be. And then that'll set your start month for harvesting. Below here, we have the plants harvested per month, the plants harvested per year, and the pounds harvested per year, just as a bit of a sense check for you to make sure that's in line with what your expectations are. Okay, so we did mention that each of these three types of growing, these three modalities, are going to have different assumptions. So, for example, outdoor is going to be very seasonal, so you can input the sales here. You'll see that in the after harvest, typically September through December, you're going to have higher sales. You're going to have lower sales the rest of the year. You can adjust these numbers however you like for bud and trim. We have our expected yield. This is going to be accounting for spoilage. So whatever percentage you put in here is going to, if you have 95%, that means 95% of the dry weight that you are harvesting is going to be going into jars, for example, or wholesale, versus 5% is going to be loss, which there's always going to be some percentage of loss. We then have this harvest allocation, which is basically saying how much of the product that we're harvesting is going to be packaged and sold versus sold wholesale. And when we're talking about wholesale in this model, we're talking about untrimmed product. So that wholesale flower, we're going to have our own pricing for it. And then alternatively, these packaged prices are going to be up here. These are going to be something you're going to want to pay very close attention to. Pricing in the flower market changes all the time. We have it broken out by A, Bs, and Cs here. We have our wholesale, again, that's untrimmed. So there is a calculator here that says an untrimmed pound is about 1.3 times a trim pound for the extra stock and everything, sugar leaves, etc. We also have a trim assumption, which is this is as a percentage of the total the total trimmed buds. We say we get an extra 30% there. And then a trim price. And then these numbers here, these percentages are price compression or inflation. So each year we can adjust that pricing upwards or downwards. Because you're in New York, if it's anywhere near close to 2025 or 2026, you're going to be in a market that's likely experiencing price compression, which means you want these amounts to be negative. You want your prices to be declining over time. And that's because there's going to be new competitors coming into the market every day. The people are going to get more efficient, they're going to get more competitive, and that's going to mean that prices are going to get lower and lower. So you do want to make sure that you're planning for that. The best way to do it is by having this price compression happening here. If you notice on the executive summary tab that your revenue is kind of peaking and then starts going down and you're worried, it is just a function of that price compression. Your average price per pound is going to go down over time. So you'll hit some kind of peak about 3 years in maybe, and then you'll start to see like a little bit of a decline. It happens a little differently in every market, but every single cannabis market that's legalized has experienced price compression. So you should definitely be prepared for it. We talk about this at length in the courses that accompany this financial model, which I would recommend that you watch. Indoor down below, these are all the same just for indoor, so your pricing is going to be a little higher. Your seasonality is going to be much more leveled out because you're probably going to do an evergreen growing program. You'll be harvesting every month. All the rest of this is functionally the same. Again, mixed light, functionally the same, but you have the ability to insert different pricing there. Okay, direct cost assumptions. These are things like your labor, your nutrients, your trimming, your drying and bucking if you're going to contract that, your R&D testing, packaging, transportation, distribution, and electricity. These are all really important things. They're going to determine what your gross margin is for your grow. These are going to be basically per plant, these assumptions here. We're going to have R&D testing is going to be a price per test and then a number of tests per harvest. This could change depending on the number of strains you're growing. If you're growing lots of strains, your testing costs will go up because you're going to have to do more of those tests. If you're just doing one batch of something that's going to go into extraction, for example, then you're going to do a lot less tests. So you want to pay careful attention to that. We have an hourly rate calculation for the trimmers and an estimate of how many pounds they can trim per day in an 8-hour shift. That's going to calculate what that trim cost is going to be per pound right here. Packaging and transportation are just a percentage of wholesale revenue. Electricity, we calculate first our estimated electricity costs for just the grow lights for indoor and mixed light. And we do that by putting in the wattage, the number of light hours per day, the price in your region. You're going to want to look this up. It changes by county, I believe. And then that'll calculate what your grow lights are going to cost per month to operate. And then this right here is going to cover any other electrical that you're going to incur. I use a 2 times multiple, so that means your total electrical is going to be 2 times whatever your lights are, just as a rule of thumb. So if you're paying 10 grand a month for your lights to operate, you're probably going to pay another 10 grand to run things like your HVAC and your dehumidifier, etc. We have some other, fuel and water and sewer and garbage costs per month there, which you can input based on your location. And that's it for the assumptions on the grow. So once you fill all these numbers in, some of these will stay the same. Some of these you're going to want to fine tune. But once you put all that in, you can go over and you can look at this cultivation tab and you'll see all these numbers will reflect whatever you put in. And so this tab is going to be, it's long, there's a lot going on. The main reason for that is because it has each of those 3 modalities kind of broken out. So this top section is going to show the summary for each of these 3. If you, for some reason, had outdoor and indoor going on under this license type, I believe you technically could do that, I think. You could see the breakdown between them. If you know you're running indoor and you're not going to run outdoor and mixed light, I'll change this. So I'll add a grouping so that you can hide these away if you don't want to see them. You'll see summaries like things like direct costs, so you can see your labor, hydroponic supplies, trimming, etc., all broken out annually on the left here, and then monthly on the right. So if you want to get into the really nitty gritty, you can go all the way to the right for that forecast. We've got some really helpful KPIs down here, things like margins, yield per canopy, square foot, and cultivation cost per pound. You have your total revenue breakdown to net revenue. There's this red line in here called intercompany eliminations. So this is because we're running multiple P&Ls in this, we don't want to ever double count costs. And so these intercompany eliminations are basically going to help level and make sure that each of these are counting their own costs, but not counting costs that are picked up somewhere else. And so that's really important. It's going to make sure that when we look at our total income statement and cash flow statement, all of these good things, we're not double counting any revenue, we're not double counting. So you'll see here, even though we do have retail and delivery in here, the COGS are all going to be picked up by the cultivation and manufacturing. The retail and delivery are really just going to be OPEX. And so that's where some of those intercompany cancellations come in. So we're going to add some of that OPEX or that COGS into these segments. We're going to remove them from these. So there's some things going on behind the scenes here that you don't need to worry too much about. But if you look at this and you wonder what's going on, that's why. You also see here on the revenue, the cultivation revenue is just going to be third-party sales. It's not going to include transfers that are going to then be sold through the retail and the delivery segments. So we have this kind of adjustment happening here. So that's the cultivation. You can see things like inventory, the total number of pounds that are sold. Again, if you adjust that seasonality of how much you're selling when, then these numbers will update. You can see things like, how much is being produced. If we go down to our indoor production forecast here, you can actually minimize these. So if you wanted to get rid of, I'll update that. If you wanted to get rid of, the outdoor, for example, so that it's not such a big tab, you can hide those. So your indoor segment here, you can see we have 3,500 square feet of canopy. You've got your yield on a monthly basis. So in this case, we're producing about 142 pounds of trimmed and packaged flower, 46 pounds of wholesale bud per month, 43 pounds of trim a month. We've got some waste in there, and then we have our total biomass production. And then we have our inventory and our sell-through and how many pounds are we selling per month, et cetera, and a breakdown of our costs as well. So this is like the total number of labor, what are they getting, how many days they're working that month, what's the wage rate, et cetera. You can see the detail of all of those costs that we already went in and inputted, just if you wanted to look at it. All right, that's the cultivation segment. I'm going to put a pin in it there. And then we will meet up for manufacturing next. Hey everybody, welcome back. Our next segment is going to be the manufacturing segment, where we're going to look at the assumption tab inputs for this segment, and then also a quick look at the production flow and manufacturing segment P&L. Let's get into it. All right, so first thing we're going to see here under this manufacturing segment is we do have a switch. So if you were to turn this switch off, the whole thing just disappears. Don't fear, if you just switch it back on, it'll come back. What that will also do is if we do turn this manufacturing off, you'll see on this executive summary, it zeroes it out. So if we were to go and look at the manufacturing tab here, we have no information. The reason that we have this is because some people that have these microbusiness licenses will not want to do manufacturing. They just want to grow it and sell it. And that's okay. But for us here, we do have it on. I just want to walk through it with you. So first thing first, we organize this basically using a margin, a gross margin by product type to figure out, rather than going through the complex detail of building up every single item, a cost item that goes into, there's an enormous number of SKUs that we could discuss. So we just look at it category wise. We simplify it a lot just to make it easy for you. So we have the flower, pre-roll, vape, edible, bulk oil, concentrate, and others. And you can just set whatever the gross margin is that you expect to get. Now, if you're not really sure what your gross margin is going to be, and you're looking to kind of calculate that, we do have this unit economics worksheet tab. This tab is not linked to the model. It's just to use as a calculator. So you can put whatever you want across here. You can name any SKU of any product that you want up top. And then you can basically just put in, okay, well, what's the flower price per pound? What's the total grams of distillate or shatter or terpenes or whatever you want to put into that SKU. You can break out all of your packaging and labeling and testing costs here on a per unit basis, estimate what your labor is going to be on a per unit basis, and then put in what your price point is and your revenue. This will just help you figure out what that margin is. You're going to look at this bottom line here. I won't spend too much time on this tab. It's really just here for you to use. Again, it's not linked to the model at all. You can put whatever you want in here. It's not going to change anything. You just kind of want to figure out what that gross margin is in terms of the napkin math, and then you're going to go back to this assumption tab, and then you're going to pop them in here. Usually, you're going to see gross margins around this. I mean, maybe you probably get a little higher, honestly. And then on the right side here, we're going to input what our unit price is. So what we're going to be doing is we're going to say, okay, what are we selling this unit for wholesale to a retailer? And then what's the margin going to be? And that's going to determine what the cost is to produce each unit. Okay. The allocation on the right here, it's going to say, okay, based on some other inputs, how much of our total pounds is going to go into which category. So the manufacturing allocation, once we have our gross margin and we have our estimated wholesale pricing for the category on average, there's going to be some scaling and pound allocation so that we make sure that we're not selling more product than we're actually growing. And there's going to be an allocation, not just of biomass, but of total units that are sold. These calculations are going to happen in the production flow tab, which is complex, but you can go there if you wanted to see the math that's happening. It's basically just going to break down where all these pounds are going to go, between finished flower, wholesale, packaged products, in-house, so within our own retail, and then sold to third party. So that's going to break everything up. You do need to go down to the retail section here for this product allocation. And we just say how much revenue we're going to get from each product type, just split it up. And then that's how we're calculating the pounds that are going to be required and the number of units sold for each type. So it is quite simplified to make it a little bit easier for you. You can see all these splits and everything. All of these ones, the only ones you really need to worry about are the yellow ones for the inputs. And it'll calculate all this stuff off of that. We do have internal brands and then white label manufacturing, which are the two key segments of the manufacturing business. So white label manufacturing is basically you are selling manufactured goods to somebody so they can put their own brand on it. And then internal brands are going to be you're preparing your own products for brands that you're going to sell directly into retail. So those internal brands typically are going to see a higher margin than the white label manufacturing brands. In here, we do have that margin the same, only because we're calculating the margin that we're getting on the cultivation side already. So just to explain it one more time, it's just important to understand, because we're looking at the P&L, we're basically considering each of these segments its own business. We have the cultivation making its own revenue based on selling products. We're assuming that the manufacturing segment basically buys the pounds from the cultivation segment to put into its products at market pricing. And that's how we're able to, if we look at these different tabs, we're able to see what is the actual cultivation margin relative to what is the manufacturing margin here. And how are these each performing in and of themselves? And so that's how we're making sure also through these intercompany eliminations, we're making sure that we're not double counting any revenue that's already been counted, for example, in the cultivation segment. So going through the rest of these assumptions here, we have some biomass requirements. So how many grams are we going to put in the average package? We've got taxes here as well, excise, city, and other. We have the average pounds per package as well, and then the yield. So for things like flour and pre-roll, this is calculating how much is actually lost when we package the product. So there's going to be some loss when we're growing it, and there's going to be some loss when we're packaging it. So we'll now calculate that we need a little bit extra weight to hit those numbers. We've got some OpEx down below. It's pretty simple, pretty straightforward for the manufacturing. General, which can just be for anything not listed, janitorial, security, supplies, utilities. These are all just on a monthly basis. You can put those in there. Okay, the next section we're going to look at here, we've got this production flow that we talked about, and then we have the manufacturing tab here. This is a little bit more simple. It breaks everything out between white label and brand sales, as we talked about before. You will calculate COGS for each of those. You've got your gross profit, your operating profit, again, KPIs. So each of these tabs is going to be really similarly structured. Number of sales, like number of unit sales, price per unit, all of those are going to be happening down below here. Just to get into the really nitty-gritty details, how much biomass we're using for things like vape, edible, bulk oil, flour, etc. And then the house brands will happen. It's just going to be the exact same breakdown as the white labeling above, and then our total sum is at the top. That's it for the manufacturing. I'll meet you on the next video for retail. Our next segment is the retail segment. So we'll walk again through the assumption tab and the inputs you have to put in to reflect your retail, and then we will walk through the segment tab for retail that has its individual P&L, just as we've done with the cultivation and manufacturing before that. All right, so for the retail, it's really simple. It's getting more and more simple as we go. So again, you can turn this on and off. It will just erase everything if you turn it off. We've got our square footage that was set up above. This first one here is basically just an override. So we're saying how much of the total manufactured products are we going to be able to sell through our own retail channel. And then whatever's left over here is going to be sold through delivery. So right now we're assuming it's 50-50. And this is just of the internal brands. You can only sell brands that you've actually grown and produced yourself in your stores as a microbusiness. You can't buy other brands to sell them. So these internal brands are either going to go towards the retail or they're going to go to the delivery. The way that we build up the revenue curve for this is we have a number of customers per day. In the first month, we're going to assume it's going to be a little lower, and then a stabilized number of customers per day, which will be a little higher. We have our average transaction size. That's inclusive of the excise tax there. And then we have this same price compression that we saw above. So we're assuming here about 4% a year. You can update that however you like. And the transaction growth curve is going to be adjusting how many transactions a day are we doing. And so this is another factor that's mentioned in the videos that accompany the model. I think it's price compression and market saturation, that course. So this is the market saturation part. So we're going to see some initial growth in the number of people coming through the stores, and then we're going to see a correction, and that's expected. That's going to just be caused by the number of stores in the market's gonna hit some kind of a peak. There's gonna be too many, and then only the strong ones will survive. So we'll expect to see a little bit of a decline there, and then some stabilization after. The way that the retail model is going to work is similar to the manufacturing. We're going to assume a gross retail margin by each product type. Down below, we're going to have that allocation to each of the different product categories. And this is just an allocation of revenue. So in this case, we're assuming that 44% of the revenue in each year is going to come from the flower category. You can adjust it year on year for these margins. They don't have to be the same across. If you think, okay, well, our margin for flower is going to improve with time, you can build that in. You'll see that average unit revenue on the right here. So you just want to basically double check that and make sure that, okay, is an $8 pre-roll at retail reasonable? Is that kind of what that price point is going to look like, or a $30 eighth? And just make sure this reflects the types of products that you're going to have. Maybe you're going to have a really premium product. You're going to want to make some adjustments to that. Down below here is just labor assumptions. So how much of the cashier is getting per hour, how many cashiers are on a shift. Typically, I think these microbusiness retails are going to be on the smaller side, because you can only sell product that you've grown yourself. You can't have a whole wide variety of different popular brands. You're going to have to make them all yourself. Got some things like labor inflation in there, general manager and or assistant manager salaries. And then you've got your other OPEX, so professional fees monthly, supplies and subscriptions. You don't want to double count anything here. This is just things that are specifically related to the retail. You don't want to, so if you have professional fees up above that are general for the whole company, this would just be in addition to that. All right, and then we'll run over here to the retail tab. So this one's pretty simple, pretty easy. We can see the number of transactions per day here, the average transaction size down below, how many sales are we doing by each category, and then what those COGS are by each category. Again, we have that intercompany elimination, which is basically wiping out all of the COGS, because each of these COGS has already been picked up by the cultivation and manufacturing segments of the business. So this is pretty much running 100% gross margin. This is a little bit misleading because, we are buying these products internally, but we're basically, as far as this is concerned, you're just transferring those products over. And so effectively our operating profit down here below and our operating margin is going to be there. So there's a summary of the number of units sold and how much biomass is sold for each category down below here. We look at product demand. So we want to make sure at all times that our supply is exceeding our demand. If we were to, for example, make some edits to the amount of product that we're selling. So if we look here and we just said, okay, what if we're selling, 1,000 customers a day, right? Then if we look at our executive summary, there's no errors here. But if we go in here and we look at our retail, what we're going to notice is we've got this target transactions per day, and then down below we're going to see actual transactions per day. So that's supply restricted. So the model's been built to only allow you to sell the product that's available to sell. And that's why even though you put in 1,000 transactions per day, we're only selling at a peak 145 transactions a day. And that's just to make sure that we're not selling imaginary product that doesn't exist. So that's one thing to keep in mind when you're going through here and you're looking at this. You will want to just double check that retail tab. There's no error message for that because technically it won't create an error. But if you put something in here that's too high, it's just going to automatically sell whatever supply is available. And it's just worth flagging that. I believe that's it for the retail tab. Just supply and demand down below. Maybe on the next video for the delivery. Hello again. This is the delivery segment walkthrough. We're going to look at the assumption tab once again for the delivery inputs and then for the P&L specific to the delivery segment. This will be very similar to the retail in terms of its form. There's only a couple differences on the cost side of things, but we're going to run through it for you here. All right. So first in the assumption tab, once again, we are able to turn delivery on or off. If you're not planning on running delivery, you can just switch it off and it'll all disappear. If you are, keep it on. We've got that area that was set above. The percentage of manufactured products sold via delivery is just going to be whatever is left over from this cell D431 above for the retail. Again, we have a similar metric where we're using the number of customers per day to sell through that product and then average basket size. Typically, that basket size will be higher for delivery than it will be for retail. People just want to get their batch and you might set a minimum order, for example, to make it worthwhile. We do have a delivery fee in here, so that's per delivery. That's going to add an extra revenue line item. Compression and growth curve are going to be functioning just the same as they were in the retail above. We have the same type of function for our allocation. I believe this may even, it's not linked. But cost assumptions we have, again, just a gross margin. You could set this to be different than the gross margin for retail. Right now, it looks like they're a little bit higher. Typically, you're going to want to have 45, 50, 60. Yeah, they're a little bit different. Typically, you might price your delivery menu a little bit higher, and that could be an alternative to the delivery fee or in addition to it. And that's just to cover that extra labor to get that run out to them. We have some costs that are in this COG section, like fuel, so number of gallons per day per car. What's the price of gas? What's the average toll fee per day? We have a slightly different labor because we've got the pickers and packers and we've got the drivers as opposed to cashiers and inventory. Pretty similar. Quite often you're going to have, if you have a manager at the retail, they'll probably also manage the delivery unless it's a really big operation on the delivery side. So you don't want to duplicate. If you've got a manager here and here, it might be overkill. Right now, there is one in each. And then again, we have these costs just specific to the delivery. Nothing, we don't want to double up. So we've got 5,000 here. We've got, another 3,000 up top here. So you may just want to simplify that a little bit, reduce it, because I think we also have professional fees way up here. Professional fees, yes, we have some general professional fees up top as well. So just be mindful. There's a few different sections for that. You don't want to be double counting too much. It was totally okay to zero them out if you've already got them counted above. Advertising, banking, vehicle maintenance, and security. That's all pretty straightforward. And then if we look at our segment P&L here, it will look very similar to the retail. Transactions per day. We do have this supply restriction once again. We've got the average transaction size, which is changing as it's compressing over time. And all of these are going to look the same pretty much, except for a few different cost categories that we have here. Operating margin in there, same eliminations that we had above, number of units sold, and then our supply calculations are down below. That is the delivery segment. Next up, we're going to walk through these financial statement tabs. So there are 3 financial statements in this model. We have a income statement, we have a balance sheet, and we have a cash flow statement. Those are your 3-sheet financials. I'm just going to walk through where they pull from and what they look like, just so we cover those ones off as well. So those 3 are going to be in gray here. After the financial statement tab. So the income statement first, this is going to break down your revenue, your COGS, it's going to break them out by segment, gross profit, and then expenses. You can see your segment OPEX down below broken out as well. The rest of these are going to be just general overhead that would be effectively allocated to each of the other segments. We've got our EBITDA and EBITDA margin here. We have things like interest expense all the way down, income tax down to net income. And then we can see our dividends here as well, along with some KPIs on an annual basis, just a good sense check to see how the business is evolving throughout the forecast. If you want to look at the monthly, those are available to the right. If you're just looking at the annual, those are going to be on the left. Our next one is the balance sheet. Again, this is just a more detailed breakdown of what we have on this executive summary, which is really just an abridged version. So income statement, balance sheet, cash flow. Our balance sheet is just going to break out a lot more categories. You'll see the depreciation happening on improvements, equipment, machinery, and vehicles happening over time. You've got assets and liabilities summarized here. You've got some KPIs on the bottom, some ratios, and working capital calculations on the bottom, just to make sure that you've got a healthy running business. And our cash flow statement. So this is going to run down from net income. It'll break down 3 different categories: your cash flow from operations, your cash flow from investing, and cash flow from financing. You'll also be able to see in here, if you are drawing a line of credit, when those draws are occurring. We've got our monthly to the right, and we actually have a breakdown of those tables at the very front on that executive summary. The founder and investor cash flow tables are going to be calculated at the bottom here. So if you wanted to look at a monthly and see when those dividends actually start hitting, they're down here. You will notice that those dividends are getting paid out, it looks like once a year. So it's December of each year, we're going to just pay a big dividend chunk, which is likely the way that you're going to want to run it. You might do it quarterly, but just for simplicity, that's the way it's been done in the model. Those are the 3 financial statements. Again, they are summarized on the executive summary tab. Next one we're going to walk through is going to be the various different schedules here and what each of them kind of mean: CapEx schedule, debt schedule, and payroll schedule. Okay, next video we will be doing is just walking through the additional schedules that are in this model. Most of these tabs we've looked at already, so we're just going to run through really quickly the debt schedule and the CapEx schedule primarily. And so what we've got here, if we look at these, payroll schedule we did look at is just a monthly breakdown of each of the different staff. Not too much more to talk about there. Our CapEx schedule, this is going to include, how are we depreciating these assets and what's the monthly depreciation? And there's not really much that you're going to need to worry about here. It'll show those investments when they go in for each of these 3 different categories. And this will just inform the balance sheet more than anything. And so you don't need to spend too much time here. The debt schedule will break out each of the loans. And so there is an ability in the assumption tab, we go right back up to the very top. There's an ability to do 4 different loans here if you wanted to. They're organized under each of these different segments, but realistically, it doesn't really allocate that specifically to the segments tabs on the right. It just all goes into the total company. And so this debt, you could structure up to 4 different types of loans with all different rates and terms. And this debt schedule will summarize each of those. So here we have this is just the total up here. It's going to sum up everything down below. That's our first loan, which is $500,000. Second loan, $250K. And then down below, we will see the line of credit. So if you really wanted to look at the detail of when that's getting drawn and repaid, if it is actually getting drawn and repaid, you'll see it down below here. The next tab here, production flow, we've already walked through. It just shows how the pounds are kind of getting divvied up across the different segments. The unit economic worksheet we do talk about in the manufacturing segment. This is just, it's not connected to anything else in the model. It's just a calculator for you to put in on a unit cost basis, how much all of your costs are, what you're expected to sell it at, and then that'll calculate for you what your margin is if you need a little bit of a helper when you're inputting the margins for your manufacturing tab. And that actually concludes all of the tabs. We've now run through every single tab in the model. The next segment that we're going to do is going to talk about any troubleshooting and just general sense checks when you're going through and populating it yourself. Once you go and start changing these assumptions, all kinds of different things are going to happen. So we'll walk through a couple of things to look out for once you start using the tool.
Okay, this next section we're going to walk through sense checking and error flags. So what do you do if the model is just not working for you? You've got errors, you're pulling your hair out. These are some of the common pitfalls to keep an eye out for and just double check once you've gone in and populated all of your assumptions. And we'll dig into each of them. So the first thing that we'll touch on here from a sense check perspective, you just are going to want to, once you go through, you're going to run through, populate some of your cost items in your budget here first. You're going to skip down, you're going to put in a bunch of all your operating expenses. You're going to estimate what your square footage is and the timing of when everything's going to happen. Populate all of these different tabs down here, basically this whole sheet. Once that's all populated, you'll circle back, you're going to update your source of funds, you're going to update your, you take a look at your equity, how much do I need to raise, what's my valuation, and then you'll look and see what this says here. And if you're not fully funded, you're going to need to either add, like we talked about earlier in the course, you're going to either add some working capital up top here to buffer that cash flow and fund the project, or you can go in and you can put some additional debt financing in, and that will also help to bridge the gap on your cash flow. If you're getting a number here, so if we were to update this and create a cash shortfall, so I've just reduced that by about 700 grand, 800 grand. Now we have a cash shortfall. One thing you can do is you can look into the balance sheet and you can look at the line of credit line here, this row 34. And you'll want to just go into the monthly and look at when am I actually hitting this shortfall and for how long and how bad is it. So the balance sheet will tell you the total aggregate amount of that loan. So this is basically, if you look at the cash flow, this is going to show you how much you're drawing each month. So this is not aggregate. So if it's positive, that means you're taking money out of the line of credit. If it's negative, you're paying it back off. Okay. And this, the way the model is set up, it will pay off any available cash. Will first go to paying the line of credit off before going to dividends or anything else. So this is going to show how much monthly you're going to need that you're shortfalling, and the balance sheet's going to show total. So what we do is we calculate and we find what the highest point is. In this case, it's this 750K in July of 2026. And one of the things you're going to want to look at is first, before you go in and say, oh, well, I need to just fund more cash, make sure that the timing is all making sense. So if you look at your income statement, for example, and you look at the monthly, you're going to want to see, okay, are my revenues hitting when I'm expecting them to, right? Are my costs, I'm going to hit costs first, I'm going to have a period of time where I'm not getting revenue, then that revenue is going to kick in, right? And then my retail and delivery are going to kick in at these times. Double check that the timing is all right, because usually if there's a problem with the cash flow and you're looking at it and saying, hey, you're like, I know I can do it for less than that, double check the timing, because it might just be that if you, for example, let's do something here. So if we look at our cultivation fundraise here, maybe you put this in like September, right? And even if you have that 1.6 million that we originally had, which before fully funded the project, now we have a $600,000 shortfall. And you might be pulling your hair out. Why is there a shortfall? It's definitely, we should not need more than this 4.5, right? If that's the case for you. The problem is we're not getting that cash inflow. So if we look at our cash flow here and we look at our capital raise, we're getting 1.8 in January, right? But we're not getting this 1.95 until September. And so what you're going to see is if you look at that line of credit, oh, we're running out of cash right here, right? And that's going all the way down. If we were to add those numbers up, or if we looked at the balance sheet, our line of credit is going all the way up to 600K before that additional cash gets invested. And we can see here our paid in capital goes from 1.8 to 3.8. So that cash and the cash flow, that 1.9 is coming in September. So this is just a timing issue. The dollar amounts are right. We just need to pull this back and make that investment in January, and now we don't have that shortfall anymore. So really paying close attention to the timing, make sure it all makes sense, have a timeline like written out, and then just plug these all in and make sure it all makes sense. And then use these tabs as your guidance to look at the monthly and say, okay, does this really make sense? Does it make sense that I'm spending 800 grand in March and then an extra, close to 800 in June? And it's not going to be perfect. It doesn't have to be perfect, right? If you know, for example, that, this is actually going to be a monthly thing and it's going to be 50 grand a month instead of, big chunks like this, it's okay. Just put the chunks in because you're going to want to raise the money one time or two times, not every single month. And so it's okay if it's not perfect. It's still going to get you close to the same answer. But yeah, look at the timing, and that's going to be really important. The next thing is just really make sure that you're looking at this often. A lot of these should never show up. So is the balance sheet balanced? The way that the model's been protected, all of these ones should really never trigger. The ones that are going to trigger is this cash flow one and then this allocation error one. The rest of these, hopefully, you should be insulated from, and they should never be a problem. So let's talk about the allocation errors. This one's got a little note on it. It just says, look at the assumptions, find the error flag. This is only triggered by if you put in a percentage that doesn't add up to 100%. So if it's an allocation, for example, here, we did this example before. If we increase this retail, we reduce the retail to 0. Now the sum of these numbers is not 100%. That's going to give us an error flag there. And that's going to cause an error flag here. So all you would need to do if you saw this error and you didn't know where it came from is you would go into your assumption tab and you'd scroll up and down looking for that red cell. And once you find it, then you know, okay, look at this note. It's going to say the allocation percentage must add to 100. So you'll go in and you'll fix that up, and then it'll be better. Those should really be the only errors. You see we've got these allocation ones here. We've got it here. There could be an issue if you accidentally left one of these on and you're running two different cultivations at the same time. You'll notice here this all went really wacky when I did that. And the reason is just because we have 2 on, but then we have a bunch of zeros here. So there's no land allocated, but if we looked at our cultivation segment, our outdoor is trying to calculate because it's saying, it should be on, but there's nothing inputted. And so that's giving us this div 0 error. So if you see something like that, this is one of the very few areas is just allocating between the 3 of these. So you would have to, you could go and you could say, for example, 50% here. That's going to give you another error here on the total. And then we want to go 50% here. Now we're okay. And then if we look at our executive summary, we're okay on everything here. But, look, because we're running that cultivation now, we actually do have a cash shortfall that needs to be addressed. But that's okay because we can look at this, we can say, okay, maybe we need a little bit of an extra loan or we need more working capital. Realistically, I don't think anybody's going to run both outdoor and indoor on the same model. So I think it should be okay. Basically, you just want to go into those assumptions and you're going to just turn that back off. And then readjust your percentages here. All right. Most of these drop downs are going to help you avoid using a wildly inaccurate number. But something like this, like on the yield per light, do your research. Look at what's typical. You're not going to hit 4 or 5 pounds a light. So there are some areas where you can kind of misstep. But the numbers that we put in here, we tried to make them as realistic as possible for this license type. The pricing should be pretty close to, mid-tier type pricing in today's market. We buffered it a little bit. It's a little bit conservative. So That's another area is that some people might misstep. Another point to be made is just on this wholesale versus package. The package is going to have a much higher margin and it's just a higher revenue overall than the wholesale. So you're probably going to want to sell a lot more packaged goods than wholesale. Just a quick note on that. So if there's an issue, if you have a problem, you can reach out to us through this contact link here. You can reach out to OCM as well. Let us know if you find an error. We're going to go in and we'll fix it. If something's not adding up properly. We're happy to help. And I think that pretty much concludes most of the shortfalls that could happen here. We may put out additional versions if there are any updates that go through. But hopefully it's tight and hopefully it all works well for you. That should conclude our course and our walkthrough. I hope you all find this really helpful. If you need additional support building some other functionality into this model, we're available to do that, to support that effort at Triple Beam. Again, just reach out to that contact form and we'll do it, just on an hourly basis for you. And we're happy to add that additional, detail however you need it. And we're very quick and comfortable with the model. We spent a lot of time building it. So I hope you all have a great day. Thanks for joining this and watching this very long walkthrough, but hopefully it helps make this tool really efficient in your hands. Have a great day.